Welcome back. The Nifty down 240 points once again. The Nifty Bank is down 700 points. We are seeing a sell-off, and that's actually, showing up in the India VIX as well. When we pointed out that the India VIX is moderated now from the lows, we've seen a bit of a spike in that as well. And it's not just the Nifty Bank. A couple of these, non-Nifty Bank index heavies are also losing steam. So L&T is at the low point of trade. Hero MotoCorp is at the low point of trade. We have Bajaj Finance, which was the top loser in yesterday's trading session, continues to see some selling, currently at the low point, along with something like a Maruti Suzuki, which is about 3.5% lower. Amit Gupta, head equities of Motilal Oswal Private Wealth, joins us on the show. Amit, are you finding any opportunities in the current volatility? And what's your asset allocation strategy right now? Are you sitting on more cash, raising cash levels? Are you deploying? How is it working?
So I think sitting in cash is very much required because there were very few hiding places in the market. Like banking was one of the hiding places, no doubt about this, and it was performing well. But then we saw the crude prices started moving up. If crude prices are going higher, eventually the bond yields can also spike. And as a result, the treasury profits can get a hit actually for banks. That's a very simple maths. And I think that is the reason the banks now in the last 2, 3 sessions, they have also come under pressure. And that is the reason we feel that sitting in cash of 15-20% makes sense in the current scenario. Along with this, I think going forward, once we have seen gold, silver, those kind of commodities performing, I think the base metals can also reverse. And metal and mining is one theme that we are looking at, actually, even going forward, at least till the situation is not getting stabilized.
So to build a 15-20% kind of cash position, Amit, what have you sold from your portfolio?
So you will have to look at some positions which are in profits, even some positions, which may be coming into possibly losses because there is a sudden surge of crude and the raw material prices can go higher. So we have to consider all these aspects and then start closing some of the positions. Some harsh steps needs to be taken. Otherwise, the losses can be more deeper losses. So this is where if you look at our portfolios, almost in our advisory desk, 95% of our schemes are either in line with the benchmark or outperforming the benchmark because of this reason.
And you're willing to sell even at these levels because you fear lower levels are going to be coming?
So, definitely, if the crude prices, start sustaining above $100, or if it breaches 120, then I think the proposition will be little tilted. So those stocks, which were looking much better, their actually profit growth in the coming quarters may start looking lower. So I think in that case, the stocks can decline. So yes, those kind of harsh decisions in these kind of situation needs to be taken, or you shift your money into some other areas where you feel that it will be lesser impacted. So for example, take the case of pharma as a pack. We feel that pharma may be the beneficiary of the IT money moving in, because when IT was impacted because of artificial intelligence, we saw the money was moving into financial services. Now financial services, when the crude oil prices are going higher, they are also impacted. And that is the reason we feel that the money can move to some extent into pharma space also. I understand some API prices can go up, but eventually when we have a good terms now with US, that scenario of anything could be announced on pharma may not be there. So the companies which are moving into high value complex products, the companies which are moving into biosimilars, because in the budget also government has spoken about that. All the complex diseases like cancer and all, where the drugs prices are costly, government wants to bring the biosimilar thing so that the drugs can be available at a better price. So the companies which are moving into that, I think they can be benefited.
All right. And what about manufacturing? Do you see any further opportunities here?
So off late, if you see, the auto numbers were definitely coming good. The post GST 2.0, we saw the buying also. If you look at the month of February, we saw more than 20% of growth across the segments, whether it is passenger vehicles, whether it is two-wheelers, whether it is tractors, it was seen. In fact, two-wheeler was one of the laggard space. If you compare with the pre-pandemic financial year 19, 2.1 crore of sales, actually it did not happen that it crossed that number in a annual in a year. Now, if you see, this number is somewhere close to 1.95 crores as of the ending of February, and it looks like it can cross the pre-pandemic numbers. Now, this particular situation which has come up now, so it can delay this process, but I think the two-wheeler is on the cards to cross the pre-pandemic numbers now, because that kind of growth is coming in.
Right. And what about some of the consumer discretionary names? And I speak about something like an Eternal or Swiggy, where there's been a serious destruction from the top in wealth. And even if you look at some of these new age platform companies, Urban Company at one point was trading just below the IPO price. Not sure if it's still below those levels. No, over the last few trading sessions, in fact, in the last 3 days or so, it's outperformed. It's up around 7.5%, but it's actually fallen over 40% from the top.
So I think the market is not giving value to high valued stocks, and these companies were trading at thin profits. Some of them were deeply in losses. They need a stable market to perform, because when you compare with those companies which are sitting in good profits and they are also getting impacted because of higher crude prices or gas prices, I think the market may not give value in the near term actually to these companies. So that kind of consolidation which we are seeing, it can continue. And we have to look at the areas where the next phase of growth, earnings growth can come, and which are attractively valued. For example, if you look at metals and mining as a case, so when we are looking 2025, and look at the electricity demand, it was hardly 1.5%. But if you look at now, this year, it may go to 5% also, because the summer is intense, there is more heat waves, the impact of the war also on the atmosphere can be seen, and then the monsoon can be weaker. So in that case, I think the AC sales can pick up, electricity demand can pick up. So the coal as a alternative, I think from the mining perspective, is going to pick up. If you look at Rotterdam, which is the benchmark in Europe, Rotterdam coal futures, they are already breaking out. If you see Australian benchmark or South African benchmark, they are also breaking out. So last 1 year was mostly range bound, $95 to $115 for coal. But we have seen that there is almost 15-16% spike coming from there. So Coal India, for example, last 2 years, the EPS decline of 21% was seen. We feel now 8-9% of EPS CAGR growth may be there going forward. So these companies which are beneficiary of power demand coming up, and then the alternatives to the gas when the prices are higher, I think they will be the direct beneficiary now, where you can move some of the money.
Thank you very much for that. By the way, Stuffcraft